Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. I have another great show lined up for us today. M&A and the decision whether to sell your practice have been some of the hottest topics in the wealth management space over the past few years. Well, I have on the perfect guest to provide some valuable insights into these topics and so much more. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, let's go ahead. Enough from me. Let's go ahead and bring on the star of the show and get started. I'd like to give a very warm welcome to Tom Prescott. Tom is the co-founder and managing member at Advisory Services Network. Tom, thank you so much for coming on the show. It's an honor to have you on. And our previous discussions have been very fun. So I'm very positive, confident this is going to be a fun conversation too. Can you please tell us a little bit more about yourself and Advisory Services Network?
Certainly. Number one, thank you for having me. I've never done one of these before, so it's a new experience. This is my 45th year in the business, and I spent the first 10 years actually in the industry. I went to work for Lehman Brothers, Q and Loeb, the real Lehman, not the bad bank of Lehman. But ultimately, from there, I ended up starting a consulting practice, a mainstay capital markets consulting, where I was joined by other industry experts, regulators, what have you. We served the industry. We created breakaway broker-dealers, advisors, helped with regulatory issues, arbitrations. And that business actually still exists, although it's such a small portion of what we are today. But it was what led ultimately to Advisory Services Network, which we call ASN for short. ASN, that's the difference maker, I think, in ASN is we came to the business wildly different from most firms. We came from a consulting background. We took everything we had learned for building firms for other people and folded it into a single unit, meaning ASN, so that it would have all the bells and whistles, everything that was needed, versus most of our competitors came from an adjunct of another firm that was creating to create something else. So we brought a different perspective to it. From a high level, that's pretty much where we are.
Fantastic, Tom. Well, it's an honor that you chose Adjusted for Risk to be your first podcast appearance. And I'm sure there's going to be many, many more. So fantastic.
We'll see how this goes.
I love it. I love it. You know, your wealth of knowledge, you have all the experience from consulting in the wealth management space. As you know, in my 20 some years experience in this space, it has evolved and it's evolving now at a breakneck pace with technology and just demographics, aging demographics, younger generations. Let's start by talking about this evolution and highlighting some of the trends you're currently seeing in the wealth management space.
Yeah. Look, trends, there's many. There's so many of them. You look at tech, you look at AI. Is it really going to provide a more efficient or an automated process? You look at the digital experience. What do the clients expect in today's world? Everybody wants to look at their iPhone, but nobody really wants, in my estimation, nobody really wants to achieve advice through the phone. They still want to talk to a human being. The pricing and fee structure that we all face it's very real. Thematic investing. Are they ESG? Are they looking at sector, healthcare? Back in my day, originally, and it used to be moralistic or biblical investing. So you still see a lot of that. But the key things, I think, are the operational structures, the data, the compliance, the tech. How do you meet all this, specifically if you're a breakaway? And then lastly, you start getting to the workforce shifts, which you just alluded to. We have average advisor, I believe, roughly 58 years old. There's not a wealth of younger people coming into the industry. We see the same in terms of staff positions, support positions. It's hard to find a young college graduate who wants to be a sales assistant or a service team or an operational person. Back in the 60s and 70s, being an operation person on Wall Street was a fine career. It's not necessarily seen as or defined as. And then you have obviously the risk factors, the cyber, the data protection. So I mean, there's a lot of different trends going on that all evolve into what creates a practice, right? And ultimately, not to ring ASN's bell, but those are the things as we were trying to create ASN, that we were trying to massage each one of those to come out with what that offering would be to meet those trends.
That's great, Tom. And everything you mentioned there, all these trends, we could have an hour long episode just on all these trends.
You
It
could.
just puts more on the plate of a financial advisor and just trying to handle all these different trends and just like you said, technology in this generational wealth transfer. And all of a sudden you're talking to 30 or 20-year olds and they want, like you said, they want data on their iPhone at all times on demand. It's like, how do you handle that compared to your legacy clients that you've had for 30 years who just want in-person meetings? So a lot to uncover there. And then you have the M&A space, right? How do you
Right.
handle that? So I think most believe that you have to have a practice north of $100 million to even consider going independent. Is that true or is that a misconception? And when are advisory practices big enough to consider going independent?
Depends on what your vision of independence really is. Okay. If you check in with the various custodians, and it changes from time to time versus what their transition schedule looks like, but the average size probably is north of 100. Depending upon other custodians, they might tell you 250. So it really comes down to what the rep who is going to create the practice wants to try to create for himself. And then I'll leg back into the other option. But ultimately, a rep's usually coming out of a wire, another firm, another independent firm, and they're looking at, okay, I've got a great client base. I want to create this. You really have to look at everything that goes into what a practice should be, a well run practice, right? With all the practice management tools, risk management tools. When you start stacking those tools, you start stacking the tech stack, you start putting the added costs on. Do you have a real compliance officer versus an outsourced compliance officer? You can be spending hundreds of thousands of dollars on a compliance officer alone before you even get to everything else. Yeah, it ultimately affects what the EBITDA or the profit of the firm is going to be, and whether or not it's going to be seen as a profitable venture. So that's where you get into that 100 million, 200 million, or even higher in terms of what you would have to have in assets under management and what you're once again charging because of the fee compression. When you circle back around to the quote unquote other options for independence, that's where ASN comes in, right? Or a firm like ASN. And there's more than just ASN, there's several out there. As an ASN, we basically bring compliance, operation, risk management, tech stack. We bring the practice management, open architecture investments, and we do all of that and more, the transition experience. We do all of that for a very slight sliver of the pie, if you will. Call it 10 basis points, 11 or 12 basis points, or in some people's vernacular, it's going to be a 15% or 10% of the payout. And if you can get to the independence, and that, like ASN, every one of our reps is self branded. They show themselves, they show that they're a member of Advisory Services Network, but they own their practice, they own their clients. If they ever decide to leave ASN, they pick up their clients and they leave. We never compete. We don't keep clients. So it's a path of independence with guardrails. We have everything that you would need, and it's yours to use or not use. So when you sit there and say, yeah, we have the ability for your clients to look at things on the telephone, they don't have to. You don't have to offer it. We have logins for our performance software. You don't have to give it to your clients, but it's available to you. So, what pieces of the tech stack do you really want to use? So that becomes the overreaching. How do you answer the wants of the advisor? Is they're all here for you. You can build your own practice and you're going to be here, or you can join a firm like this and you're going to be here. You're both self-branded, you're self-own your clients, you're self-driven, you're building your own practice. But where do you want to be served? Do you want to be a single man or a two man or a person shop? Or do you want to be with a full staff behind you that is unseen and unheard? So that's where it gets wildly different. To be an independent firm, 100, 200 million. We've brought firms on ASN with 10 million and they've grown their practice to 50 or 70 million. Our average shop has between 50 and $100 million. Our largest shop is almost 500 million. So we can serve a very wide swath of people in independence. But you have to first decide, do you really want to own the IA or do you want to own your brand?
Tom, that's a great way of putting it. Do you want to own the IA or the brand? Important decision there. And I love how you started that conversation statement out stating you got to know what you want to be, as a business owner or financial advisor. I talk to a lot of people. It's like, well, what do you want to do when you get older? Some people ask me, and I'm still trying to figure out what I want to try and be when I get older and all that stuff. But it's so important to understand like really what you want in your practice before you can start making these decisions. So,
Well,
you
that's the homework portion that most people don't do. If you do the right homework, you do the right planning, right? Then you know what the choices are, then you pick the best choice for you. And there's a lot of competition in this industry. So you see a lot of vendors coming out, oh, we can help you build your own firm. We'll get you registered. We'll turn you loose. We hand you the keys to the car. You drive the car off the lot. You either do or you crash it into the first telephone pole. So what is it that you need to help make yourself a success?
yeah, and it's so important, like you said, to do that planning. It might not be the least fun or the part of the decision making that you don't want to do, but it's arguably probably the most important, I'm assuming. Yeah. You talked about some of the smaller financial advisory practices. You mentioned you have clients that are, or affiliate firms that are $10 million, 20, 30, $40 million, but they often face some maybe different issues that larger firms face. What are some of the bigger issues these smaller advisory practices face today?
The smaller ones that are joining like an ASN, it's whether they want to use the entire platform or what pieces they want to use. Certain like compliance regulation, we do all of that. They don't have a choice. But what most firms, if they're trying to create their own either state registered advisor or federally registered, if they're over $100 million, it's what pieces of technology are they actually going to spend money on? Are they going to outsource compliance? The interesting thing about outsourcing compliance is you can't outsource necessarily the CCO role. So I'm the president of a firm. I'm also the CCO of a firm. So if you outsource that and you don't get it done right and you get dinged, the president of the firm's getting dinged by the regulator as the CCO. So if you're cheapening up, it's a terrible way to put it, cheapening up the value of your firm by cheapening up the pieces that you're putting into the building blocks, then you're making a mistake. And those are typically the mistakes. I'm not going to go out and spend the money for a performance software. I'm not going to spend the money for a good compliance service. I'm not going to spend the money to have a good assistant or this, that. So those are the mistakes that are made. If you're a one person shop siloed in your basement and your entire business model is to get as many assets, charge as much as you can, and have very little behind you, it's a disaster waiting to happen. And most people don't do that, by the way. It's economies of scale. What do they think they can afford versus what they want to provide to the client? To me, those are the errors that we see. When we see a rep who has had his own advisor and they're now wanting to come to us, we look at the reasons why they're doing it. They didn't have the support, they didn't have the technology, they couldn't afford it. I know we'll get into a lot of what's going on with the private equity, but private equity is also buying the vendors that serve our industry. They bought Orion. Orion ended up buying Redtail. Redtail's a CRM widely used. All of a sudden, you saw Redtail prices go up because private equity bought, right? So the cost structure continues to go up. but yet fee compression pushes down on the industry as a whole. So it's honestly trying to make the right determination. Those are the biggest errors, is what you're willing to cut out in terms of your service
Yeah.
model.
It's interesting. Yeah, it's interesting, Tom, that you brought up the different pieces of your platform, whether it's compliance, performance reporting, CRM, marketing. What do you think is maybe the most important piece that people should? Just listening to you talk, I would think maybe compliance. You got to have compliance. Are there any other pieces that maybe you think are the most important that others might devalue?
Well, obviously, compliant is forced upon us. It's a necessary. It's a force is the wrong word. It's something that has to be done, right? But to support that, you've got to have the right file systems. Like we use Laserfish, which, maybe it's a free plug for them, but at the end of the day, it's a file system that we can have our files in the cloud. And you can be anywhere in the country. You can pick up your laptop and be in Lake Tahoe, or you could be in Miami Beach, or you could be home in Atlanta and serve your clients because your files are with you always. So it's those types of tools, because once you've chosen your custodian, the custodian brings a lot to the table in terms of their platform. So it's all the ancillary pieces, but really, compliance risk matrix. What are you doing for risk tolerance? Are you buying E&O? Are you buying cyber insurance? Which, let's face it, we're in the a disaster right now going on, particularly during the holiday season, of how many people are being touched by cyber criminals trying to get to their data. That's become a huge area within the industry of concern. So if you're not spending the right money on tech, you're not spending the right money on risk management, you've got a problem. The front end of the client, which is your services to your client, those are the givens. That's what everybody expects. It's what's behind it, right? To me, that's the most important keys.
Yeah, very good points. Because, like you say, compliance, it's a, what is it, necessary evil. But it shouldn't be looked at that way. It's a requirement and you need it. And it's something that you got to consider when you're making these
Well,
decisions.
if you're building a true business versus a practice, a true business has all the risk characteristics and matrix and everything taken care of.
Mm.
And yeah, it may be considered a necessary evil. As a group of owners of our original compliance firm, we had regulators as partners, ex-regulators. So they didn't consider it a necessary evil. It wasn't how you protected the industry and you protected the clients.
Mhm. We talked about the evolution, years ago. Was it even possible for these smaller firms to even consider going independent because of the cost? Let's say a $30 million practice. Is it just, let's say 10 years ago, 15 years ago, it was like, yeah, I need to get to 100 million.
No, and I'll tell you a funny story. When we first started at Mainstay, our main business was building breakaway broker dealers for one and two issue guys that were leaving a large firm, a wirehouse, to create their own broker dealer. We did that for 10, 15 years. And within a very short period of time, we saw the industry move from building breakaway broker dealers to building advisory firms. And I would say over 5 years, 6, 7 years, it went from 90% broker dealer driven to 90% IA driven. Why? Because the cost of entrance was significantly lower. The the processes that were controlled by previously known as NASD, now known as FINRA, they make it difficult to be a broker dealer. You've seen at one point we had 6,000 broker dealers. I think we're less than 3,000 broker dealers in the country nowadays. Part of it's because of M&A and mergers and acquisition, but a lot of it's because they've left the industry. But today, yeah, a person can create a $30 million firm or $20 million firm either through an ASN or even a state registered advisor. They're willing to do the work and pay the freight, they can do it. That would have never been able to happen as a broker dealer or a combined unit of broker dealer IA. But nowadays, you're sitting at a wire, any wire, and you've got 200 million. You're doing $200,000 in GDC, and you're making a 35-40% payout. You can actually take those clients, leave, create an advisory firm, do the same $200,000 of fee or GDC, whatever you want to call it, and now get 90% of it or 85%, not 45%. And you've monetized the practice. As you grow older, you can sell that practice. So that's what's changed within the industry. And that's what's driving right now the exodus from the broker dealer or the bank brokers or this to the advisory side. It's a simple, you can be a single person and all of a sudden bring your kids into the practice and let them grow up with a practice and ultimately leave a practice. It becomes a family institution, if you will. So it's an interesting thing that's happened, and it's really happened as it was created 16 years ago on that thought of what was happening in the industry. So that's how it got there.
Fantastic. You know, I hate to dwell on the bad or mistakes, but I think it's important because to discuss them, it can help people learn and give other people examples of what not to do. So, what are some of the bad decisions financial advisors make when it comes to practice management or, going independent or merging with another firm?
There's a lot of potential, right? How are you going to manage money? Are you going to create your own models? Are you going to use third party models? There's a hot button right now. Are you going to use alternative investments? We see a lot of the alts coming into the industry, and it's an interesting thing. Wall Street has a very strong desire to duplicate success. So you see a success with alts, success with fair private equity funds or this, and all of a sudden it gets homogenized and then pushed out in a much larger spectrum. So you have to pick how you're going to manage money. You pick the wrong money management schemes, you pick the wrong AI, all of a sudden you've made mistakes. So are you gaining the right support behind you in terms of who you're using? Are you using some of the larger firms models? Are you using BlackRock? What are you using? So we see a lot of decisions going there. But really the biggest mistake, and I'm not trying to harp on it, but the biggest mistakes are how you build the infrastructure of your firm. If you're constantly underperforming the market, you're not going to be in business anyway. But even if you're overperforming the market and you haven't built the firm the right way, you have a risk of not being in this industry for the wrong reasons. So really, it's about choosing who your partners are. If you choose one performance software over another, are they really that different? We've chosen one here that we've partnered with very well. That doesn't mean that you can't pick a different one and be successful there. But it's making sure that you have all the building blocks. It may be I'm a new grandfather, relatively speaking. We've got a 3-year-old granddaughter, and it's about taking I watch them. The building blocks that they put on to build something. It is the same story for building any business, but particularly this business. What are you putting into it? And then if you start looking at how you build your pyramid in terms of what you're going to do for your clients, how it rotates up, and what is the thing that you offer to the clients, and then below all that is what do you charge? We see a lot of reps come in here and say, "Oh, I'm going to undercut the market. I'm only going to charge 50 bips for what is an average fee of 100 bips." All of a sudden, they find out that 50 bips, once you take all the cost of running the firm, you're not making much more than you were making at the firm you left. So it's a balancing act of picking and choosing all the pieces and then figuring out what you're going to offer, how you're going to offer it, and then what you're going to charge for it. But once again, not everybody is a good business person. You can be a good client person. You can be a good money manager and still be a lousy business person. You can be a great business person, but be a lousy money manager. So if you know what you're good at and the structure of what you're good at, then you can pick and choose the other pieces that will come behind and support you. Those mistakes I see are the mistakes of omission. They're not going to do something. They're going to hire something. They're not going to spend some money that needs to be spent. If you're not spending money on compliance, if you're not buying E&O, you're foolish.
Tom, that's great. It goes back to your original statement, how we started this conversation off about just understanding what you want to be for your practice down the road and, understanding your strengths and weaknesses. And then if you
Yes.
have weaknesses, if you understand that and you're open to it, then you know what you need to maybe outsource or pay money to improve that for your practice.
Exactly.
I hear a lot about advisors just selling their book. Right? Sell your book. Sell your book. I'm not an
Yes.
author, so I'm not selling a book. What does it mean to sell your book in this industry?
Basically, on the advisor side, it's taken what you've built over whatever number of years. And some of these folks that have practices, they've been in business for 30 and 40 years, and they find themselves, if you look at all the stats of the industry, the average advisor is in his late 50s. He has to decide what is he going to do for his next act. You'd be shocked how many advisors have no next act. They have no succession plan. They have no if the bus hits me plan. Um, so the selling of the book has been put in steroids by the amount of private equity money coming into the industry. Okay. So all of a sudden you can find yourself being offered a multiple, and the multiples range from 2, 3, 4, all the way up to 6, 7, and 8. There are some significantly higher than that, but on average, it seems to be ranging between 3 and 6. Now, that's what I see. I'm not saying that is exactly right, but you have to look at what you want to do. If you're trying to sell your book, what that really means is you're going to take all your clients, you're going to walk into another firm if you're being bought by private equity, you're going to sell to the firm for whatever multiple of EBITDA or free cash flow that is within your practice. And then you're going to be required to stay for 2 years, 3 years. And within those 3 years, you're going to have to continue to keep your book in place, make sure assets don't drop. Many instances, you have to grow your practice by some percentage every year. And then you have to use their products, their models, their things so that these guys are monetizing the buy of your book. And over that 3-year period or 2-year period, you're going to get a payment up front, a payment somewhere in the middle, and a payment at the end. So now you have exited your practice. All the while you're selling your book, you're typically continuing to work for the practice buying your book for some period of time at some lesser salary than you were making on your own. Then you exit the practice. Then the question is, how many of your clients stay? You've left. The relationship was you. If you weren't moving the relationship to the buying firm, then those clients will leave. And then you have to worry about a potential clawback. Oh, this client left, so you don't get your full payout of your structure. So that's one sale, right? That's the extreme sale. That's the one that's right now driven by private equity or the consolidator or the ag. The other side of that equation is you own a practice and you know that you want to retire. You bring a young person onto your practice, you train them over the same 3, 4, 5-year period. You cut a deal with them to buy out the balance of your practice and you sell that over the next number of years, right? That is equally as good as selling your practice over here. It could be argued is actually better because you're a fiduciary as an advisor. If you sell your practice to the highest bidder, but it's not actually in the benefit of your client, have you done the right fiduciary thing? Not saying it is, not saying it's not, but it's a question, right? Are your clients going to be better served over there? Is the cost structure going to be higher? Are they going to be better served here? Or do you take your practice, merge into a younger person's practice, and then you work with them for the next 3 to 5 years, and then when you're retired, the clients are still well served? So it means, once again, what do you want to do for your future? How quickly do you want to exit? What multiple do you want to be paid? And how do you want to take care of your clients and your client book? So once again, there's a lot of different things that go into that equation, and mostly it's driven by the multiple, unfortunately so.
Yeah. As much as we like to say this decision should be, like you said, driven by what the advisor wants or wants to be, should also be what's in the best interest. And like you said, you're a fiduciary, what's in the best interest of their clients. I
Right.
hate to say it, but I have a feeling it's more driven about that check and that payout in some cases.
To a large extent, I think it is, because when you read the financial magazines, the newspapers, what have you, it's the old adage, what is it? If it bleeds, it leads. All right, this firm just sold for 7 times EBITDA, or this firm just sold for 8. It's not the given. but it's the one that makes the splash, right? There's also what's called a soft sale out there. You can actually leave one firm and go to another firm and sign a 9-year forgivable note or a 7-year forgivable note. You're still there, you're still working. You just got a ton of money to join another firm. It's a soft sale. You're not leaving that firm anytime soon unless you buy yourself out of that, but you're still in control of your practice. There's I, Not many people would call it a soft sale. That's what I call it. You're taking upfront money to join another firm. It's usually a lot of money paid out and forgiven over a number of years. What else could you call it? It's just taking money once again to move your clients to a different place. Um, Ultimately, I think most advisors are looking for what's best for their clients. When we talk to advisors and they're looking, I want to make sure my clients are best served if something happens to me. That's what they're supposed to be doing. But we also run into the advisor who says, oh, I've got a practice and I've got $100 million. I'm making $1 million a year. I want to get a 6 or a 7. I want to get the biggest check I can get. Are they really considering the clients? They might be. It's not exclusive that they're not, but they're chasing the multiple. And the firms, by the way, who are buying at the higher multiple are doing what? In 3, 5, 7 years, they're going to sell everything they just bought for, quote, another multiple extension or a higher multiple, which means that client hasn't been sold once, that client's been sold twice. So is it the right thing, good thing? I can't tell you. It's not my place to tell you. It's what's right for you and your client base.
And just provide them with the information they need to make a educated decision. Where
Yes.
you mentioned PE, and I feel as if it's a really interesting topic. You talked a lot about PE and what happens if you sell your book to a PE-backed firm and the requirements there. What's your thoughts on it? Do you I'm sure in some cases it's a good thing and people like that PE support. I mean, do you have any thoughts there?
But there's a place for it in the industry, right? There is an absolute place for it because there are firms that need to be sold. If you're 75, 80 years old, still running your practice, you need to do something to make sure that the clients will be well served. And you'd be shocked how many advisors don't have that plan yet. You'd be more shocked to talk to advisors who don't have that plan. And when you ask them why, because if I do that plan, I'm going to die. Ridiculous, but nonetheless, I've heard it. So there is a place for private equity. The question is, how's it being used? If private equity is coming in, they've got 200, 300, $400 million to spend or billions, whatever it happens to be. And we're going to go out there and we're going to buy all these practices with the stated intention of putting together a larger group. And then we're either going to sell that practice or spend it to the next person, the next private equity. Okay. As long as the clients are being well served, there's nothing wrong with it. Right? There's nothing wrong with it at all. Everybody could use more capital in this industry, right? If you want to keep up with all the tech, you want to keep up with all the things that are happening, it costs money. So it's not a bad thing. The question is, what is the intent of it? If all they're trying to do is buy books so that they can flip it out as a larger segment in 3 to 5 years, what's the point? If they're doing that same thing with the intended structure of going public and keeping the unit working, or finding a group of other private investors that like the unit as it's been built, there's nothing wrong with it. The question is, what is the stated goal down the road? But you can't deny it. There's a lot of money chasing this industry right now. It's in the papers every day.
You're exactly correct. And it provides liquidity. We talk a lot about investments and liquidity risk. P provides liquidity, like you said, which is important. Lastly, on this subject, real quickly about selling your book, when should a financial advisor consider selling their book? Is there like a time frame? Like you said, an 80-year-old probably really should be considering selling their book. Do you have any other thoughts?
Really, it comes down to the advisor's desire. You still have a passion for the industry. If you're ready to hit the mountains or you're ready to hit the beach and you just don't want to do this anymore, it's time because you're not going to serve your clients well. And it doesn't matter whether you're selling to a group of younger guys coming in behind you within your practice, or you're selling to a larger firm, or you're selling to private equity based firm. If you don't have the passion anymore, then it's time. If you haven't prepared for your retirement and your largest asset is the business which you've built, then you have to do that as part of your financial planning. What are you going to do to make sure that your family is well taken care of? It really is a very personal decision. After 45 years in the business, I will tell you, I have absolutely no desire to retire. But that's not, I've got three of my best friends who are 2 years younger than me who couldn't wait to retire. So really, it is what is personal about you. What is your circumstances? What do you need to do to take care of your family? And ultimately, do you have, forget the sell, do you have a succession plan in place so that if you were to become ill, get hit by the bus or the bread truck, that your clients and your business would be maintained and that your family, it's all about those decisions. There are groups of people right now that are doing exactly those decisions. There's groups of people out there that are saying, this is the highest multiple I've ever seen. It's time, let's get out while the getting's good. And there's the guys that say there's a more holistic or organic approach to this. I'll bring some young guys. They're not easy to find, by the way. Young folks are not easy to find coming into this industry, but there are still some quality ones out there. Quality. And if you bring them in, you train them how you did it, then you have a organic sale. So really, there's no magic button. The button is based upon who you are and the internal clock that you have.
Yeah, Tom, that's great insight, and I agree completely. All right, last question, last topic. You mentioned it earlier, and it's really hard to have any conversations about the evolution of wealth management moving forward without talking about AI. So we got to just finish this conversation with AI. Should financial advisors be concerned that they're going to lose their jobs to some robot or something's AI in the wealth management space? Should I be concerned?
My least favorite topic. The short answer is no. AI is a tool. And if you look at it as a tool, it can strengthen your practice, it can strengthen your practice management, it can strengthen how you serve your clients. For those people that think that AI is going to replace the advisor, you're an 85-year-old retiree. Are you going to look on your iPhone, look on your computer, and accept advice from ChatGPT or some other AI tool that the tech guys have built out in California? I don't believe that for a second. That's the same group of people that said all the robos would take over the world 5, 10 years ago. Did it? It did not. It was an absolute adjunct failure, in my view. Now, there are those that say I'm crazy, but tech and tech stack and the use of AI will be driving what we do and will help either lower the cost of services provided or lower the cost that we spend to create those services. It's still going to be there, but look, I'm a believer that this is a people business. It's always been a people business. You find somebody who you trust, become your trusted advisor. I have an iPhone just like everybody else. I check the markets on my iPhone. I check my account on my iPhone, but I have absolutely no interest in getting advice through my iPhone. Now, having said that, do I need to have the ability to send all that to the clients, have them get it, have them contact me? Absolutely. So that's where AI comes into play. If Elon or somebody can come up with a bot that's going to sound like me or sound like you and deliver great advice and do it based on algorithms, so be it. I still don't think people are going to take it. And I'll give you a perfect example. And here in we've got, what is it, the Waymo cars or whatever. They drive up, they get you. Do you know how many cars are being stuck in parking lots, stuck on highways because it doesn't work? Do you put your financial future in the hands of something like that? I just don't see it happening, but it's a great tool. And there's a lot of money flowing into it that I hope will make us better in how we serve, but not as a fear factor of replacing who we are and what we do.
Tom, I don't think you're crazy for that viewpoint at all. I agree completely. In that last statement that you said, it's a tool to help financial advisors, and not even financial advisors, other industries be better, right? It's not going to replace them, but it can help support their practice, make it more efficient, and help support them. And I love that you brought it back to robo advisors. I I don't even know. Wealthfront is still out there, but a lot of these big asset management firms, other firms out there that bought robo advisors, I think they shuttered them. Right, they're gone. So
Yeah.
I completely agree that AI, yes, it's a fantastic tool. Be concerned about your job? No, but leverage it to make you in your practice a better practice. I completely agree.
That's the key to me.
Yeah. Tom, thank you so much for coming on the show. You're a pro, first one, pro. I'd love to have you back. It's a fantastic conversation, a lot of fun, a lot of great insight. Where can our audience get more information about Advisory Services Network?
It's very easy. Just go to our website, www.advservnet.com, and love to talk to anybody that want to talk to us. And look, it's been fun. I appreciate it. For my first one, you've made it comfortable. Thank you.
Yeah, there you go, Tom. Awesome. Thank you so much. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and on Spotify. Please remember to like and subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.